Welcome to the CLS Market Review for the first quarter of 2013. I'm host Matt Harwell. We experienced a tremendous start to the year. To top off an already great quarter, the S&P 500 index closed at a new all-time high on the last day of March. Corporate earnings also extended to new all-time highs during the quarter, as did a variety of market benchmarks. All good. However, with some positives come some negatives. Many markets did not participate in the strong first quarter gains, international markets especially. Emerging markets lagged considerably over the first 3 months of the year. The bond market also lagged stocks by a wide margin, barely scratching out a positive return. So what does this mean for the remainder of 2013? How does this impact the investment themes we introduced last quarter? To answer these questions, we turn now to CLS Chief Investment Officer, Rusty Vanneman. Rusty?
Thanks, Matt. The short answer is that we're retaining the cautious optimism with which we entered the year, but we are now starting to put more emphasis on caution than optimism. A couple of key factors relating to the stock market prop up our optimism. The stock market remains attractively priced. Though prices were up over 10% in the first quarter, the earnings yield only modestly dropped and remains well above its 20-year average of approximately 5%. At least compared to history, stocks are still on sale. A key takeaway from this data is that, though stock prices have more than doubled off their bear market lows from over 4 years ago, earnings yields are still closer to the bear market highs than they are to the long-term average. Many believe extremely loose Federal Reserve monetary policy has been driving stock market gains. There is some truth to that, but it can be argued that the bulk of the 4-year bull market has been more about earnings growth than liquidity. CLS continues to believe that, even when earnings growth slows, as it has recently, the stock market could still push higher as investor sentiment improves and valuations continue their move back towards their long-term average. For long-term investors, an earnings yield of nearly 7% remains attractive, especially compared to long-term bonds such as 10-year Treasury bonds that yield less than 2%. Corporate earnings growth remains a positive. Though growth clearly slowed over the last year, it is expected to stabilize, and many are starting to believe that earnings growth could re-accelerate heading into year-end, perhaps even sharply so. While we remain skeptical about the sharp rebound, we do recognize that the rate of earnings growth remains sufficient for additional stock market gains. Unless, of course, the expectations get out of hand and the optimism creates expectations that will be hard to beat. Though many investors do not seem as worried about the fiscal debt situation as they were 3 months ago, we believe the situation is even worse. Debt as a percentage of GDP continues to rise. While loose fiscal policy is generally considered a short-term positive for the economy and the markets, once debt hits such a high level, the implications turn negative. Research shows that high federal government debt eventually translates into lower economic growth and higher inflation. When researchers looked at data from 20 countries between 1790 and 2009, they found that once debt exceeded 90% of GDP, inflation-adjusted economic growth was halved, nearly dropping 2% to an average real growth rate of 1.7%. Interestingly, only one country of the 20 actually experienced negative real growth when debt reached such a high level, the United States. This tells us that the eventual repayment of federal debt should provide a headwind to economic growth and the stock market in the years ahead. Our expectation is that returns will be positive, but below long-term averages.
Turning from stocks to bonds, we continue to have a couple issues with the bond market. First, real interest rates remain extremely low. When real rates, i.e. interest rates adjusted by inflation, are negative, the typical return moving forward is below average, if not negative. Unlike stocks, bonds are not on sale. Second, inflation is not yet officially a problem. However, we believe it could become a problem sooner than many people think. So, given these issues, how concerned is CLS about the bond market? Are we in a bubble, and could bond prices plummet? For insight, we turn once again to our CIO, Rusty.
Thank you, Matt. While anything is possible, we do not believe it is highly likely that the bubble will burst, at least not yet. A recent survey from the Conference Board on Interest Rate Expectations shows that a significant portion of investors think rates are going to rise. The contrarian in me loves to point out that it is typically the best time to buy. Conversely, when people think rates are going to fall, it is often a time to sell. This investor sentiment about rates is a bullish sign for bonds and a clue that imminent bear market crash is not likely. So where is CLS finding value in fixed income? Within our fixed income holdings, we have modestly lower duration, in other words, interest rate sensitivity, below that of the overall bond market. We are maintaining a preference for corporate bonds due to attractive yield ratios. And we are also looking to creatively diversify portfolios by using asset class segments and strategies beyond investment-grade bonds. This includes alternatives, hybrid asset class segments, and non-traditional fixed income securities. This said, as asset allocators, we recognize the important function that fixed income serves in balanced, diversified portfolios. Bonds continue to provide yield and the ability to manage portfolio stability.
Earlier this week, I had an opportunity to sit down with both Rusty and our Chief Investment Strategist, Scott Kuby, to discuss our 2013 investment themes introduced in our previous quarter's market review. Gentlemen, thanks for sitting down with me today. Let's begin with our focus on quality. In an environment where economic growth is likely to be below average in the coming years and where interest rates are more likely to be rising than falling, where do we see value in the market? Scott?
Thanks, Matt. We see value really in the highest quality companies. Companies that have strong balance sheets, who have good brands, and an ability to grow their businesses over time. Simply the solid types of companies that you know and you'd probably like to work for rather than invest in.
Absolutely. I think another way of looking at it is that they're not just high quality, but these are strong companies. They have strong balance sheets, they've got stable earnings, they're able to grow their dividends. And I think this is the reason why we're emphasizing these securities in the portfolios.
Okay, great. Moving on. Last quarter, Rusty, we talked about how attractive the international markets were relative to the U.S. when one looked at valuations based off earnings, dividends, cash flows, or book values. Is this still the case?
It's absolutely still the case. International markets are still very attractively priced, even more so than they were 3 months ago. The problem to that is that they've underperformed over the last 3 months. So we have not picked up any value in the portfolios from the international investments as of yet. But we think that not only are valuations attractive, but also growth rates abroad are more compelling to the United States. Emerging market demand is picking up. We're seeing a lot of attractive values in Europe. I know Scott has been emphasizing Europe in some of your portfolios.
Yeah, I think there's a great opportunity for European earnings to start to increase. The U.S. Earnings have really increased at a very rapid rate, and Europe's have been very depressed, partly from that economic growth. The improved economic growth that Rusty talked about should lead to improved earnings growth there as well as the attractive valuations, and that may represent a sweet spot for investment down the road.
Rusty, in your last answer, you did touch on emerging markets, and I'd like to kind of piggyback that as we move forward here. So if those emerging markets and the demand there does pick back up, another asset class that should do well is commodities, along with commodity-related stocks. Also, if inflation starts to percolate, commodities should outperform all other asset classes, assuming history repeats itself. Correct?
This is true. We've done research, and in environments where inflation is low, like it is now, but it's starting to rise, commodities has been the best performing asset class over time. So we think having an emphasis on commodities makes sense. We haven't been getting a lot of satisfaction out of that theme so far this year, and one reason is that the US dollar has become stronger. And while we're not bullish on the dollar long term, there's a lot of different reasons for it. The dollar has put some pressure on that commodity view so far.
To add to that, the market expectations for emerging market growth, I think, are too low. I think we have a great opportunity to see accelerated growth. And when you think about emerging markets, you think about an increased demand for basic necessities. People that don't live as well as we do in the United States living better. We would expect that would be more demand for cars, which would increase the price of gasoline, which would get right back down to oil, and more housing, all sorts of things, basic necessities that people use every day. And we would see prices are likely to increase from those, which would benefit not only the commodity, but also the producers of those commodities.
Mm-hmm.
So then, if inflation rises, interest rates will rise. And our last theme for 2013 deals with how to diversify equity-dominated portfolios and manage portfolio volatility when fixed income is not attractively priced. And what does CLS see as potential solutions for this?
I think it's a really important topic, Matt. I mean, we're calling this last theme creative diversification, and real interest rates are extremely low. Most segments of fixed income have been picked over. So how are we diversifying portfolios? We're doing it through 3 different areas, and all of our portfolio managers have been very active on this. First of all, we're using non-traditional fixed income, we're using hybrid asset classes, and we're using alternative strategies as well. And this has been adding value. In fact, one area, Scott, you've been using low volatility securities to great effect.
Yeah, we've really enjoyed the benefits in the portfolios of low volatility securities. Equities seem to be, as we mentioned, attractively priced. At the same time, bonds are in a difficult situation, and so we've invested in stocks that aren't as risky, allowing us to get more into those stocks, achieve those higher rates of return, and reduce the fixed income exposure at the same time.
To close this quarter's review, Rusty would like to introduce the members of our investment research team.
Created only a year ago, this team is already paying considerable dividends to the portfolio managers and the entire investment process in general. Though many of these individuals are veterans to CLS or the financial industry, they had not directly been involved in the investment research and management of CLS portfolios until several months ago. You'll be seeing and hearing a lot more from them in the years ahead.
Hi, my name's Gene Friggs. I'm an investment performance analyst for CLS. I've been here for about 15 years. I'm passionate about measuring performance for our clients and providing accurate and meaningful data.
I'm Grant Engelbart. I'm a research analyst here at CLS. I'm passionate about everything in the markets, but specifically commodities and derivatives.
Hi, I'm Josh Jenkins, and I'm a research analyst at CLS, and I'm passionate about the fixed income markets.
My name is Konstantin Arkos-Jaidis. I've been a trader at CLS for 2 years and have recently become a research analyst. My passions are equity analysis as well as technical analysis.
Hi, my name is Rui Wang. I'm an investment research analyst at CLS. My passion is about quantitative investment management and value investing.
I'm Joe Porter. I'm an investment performance analyst. I have been with Northstar for almost 10 years. It'll be 10 years in June. I have just recently got my CIPM designation. It's through the CFA Institute, and it helps me to better understand performance numbers and to calculate them.
Thank you, gentlemen. That concludes our update for the first quarter of 2013. Our next quarterly market review will be in July. Also, check back with us each Tuesday for our weekly market review, through which we'll give timely updates on portfolio positioning and how we're specifically applying our investment themes. From all of us here, I'm your host, Matt Harwell. Thanks for watching, and thank you very much for your time and trust in CLS Investments.